All right, good morning, everyone. Thank you so much for being here. Really happy to have Erin here. We're going to talk about some good stuff today that we're going to be able to utilize for ourselves, for our clients, our friends, our family. Um, Erin, I'm going to have you go ahead and you can introduce yourself, just say hi, and then you can get going. That would be great.
Sure. All right. Yeah, my name is Aaron Rubin. I'm a partner at RUBIN Papier Wealth Management. Our whole thing is integrating tax and wealth and investment strategy to get the best possible result. When I talked with Skip, however many months ago about the presentation, we couldn't decide whether or not we want to talk about longevity risk or house poverty, being house poor. And so we said, you know what, we're gonna do both. And not sure if we really have time for it, but I think I got something that's good and will hopefully be informative along the way. We'll probably focus a little more on house poverty than longevity risk, but we'll get her started. And of course, house poverty is, in quotes because, it's hard to say you're poor when you have a $2 million house. But, it's sort of, you sort of are, you sort of can be. But if we're talking about longevity risk, you know, longevity risk is super important. We're not all going to find, our three BFFs and, live with them for the rest of our lives. Um, the thing is that if between a couple, what we find is that probably one of them is going to at least live to age 92. And why that matters is because if we're going to retire at a traditional time, 65, which is when Medicare kicks in, we're going to have to think about a retirement that could last at least 25 years, could go longer. And so that means you have to have the assets to support that. And people tend to think that they're going to die sooner than they will. I know my parents have already told me that they are dying by 80. I don't know how they know this, but that is their plan, which is an interesting plan as someone who's a financial planner. Um, and then the other thing that has really changed things over the last, well, 30 to 50 years has been the rise of 401k plans. Used to be back in the day, a lot of people had pension plans. So they would put money, their employer would set money aside. They would have some stream of income, for the rest of their life. Starting, again, 40, 50 years ago, we started seeing the rise of the 401k plans, the IRAs. And instead of paying out a particular percent or a particular amount, what ends up happening under these 401ks, IRAs, the defined contribution plans, what ends up happening is you put in a certain amount and hopefully that amount grows to the amount that you need it to be when you retire. But again, there's no guaranteed income stream for the most part for a lot of us. There are exceptions. Certainly if you're working in government, there are pensions. They're not as great as they used to be though, because I have a few clients that have worked in governments. And then some not-for-profits will also have pensions as well. But for the most part, if you're a Silicon Valley worker, or if you work for yourself, you are using that defined contribution plan primarily. And so you can't count on an income stream necessarily. So when we talk about where our problems start to appear, um, for the first place that happen, what I see is people spend early, and that makes sense because if you think about if you're retiring at 65, typically your health is going to be pretty good at that point. And so what happens is if your health is good, you want to do stuff, which is actually when exactly you should want to do stuff. So but people again, if you're if you're too healthy for too long, you end up overspending on those discretionary items, whether it's travel or remodeling a house. Again, I've seen all sorts of spend. Um, but again, if you go at it too early, thinking, well, later on I'm just not going to do it as much, that's true. But later on, you're also going to have a ton of medical issues likely. Um, and so you have to think about that. So people also will either intentionally or unintentionally have a social security strategy that's not optimal. And we're going to talk more about Social Security in just a minute. But with Social Security, you can start at age 62, so long as you don't have over $20,000 of income. And it's easy to get $20,000 of income, working just almost any job. So pretty much, if you're fully retired at 62, you can take Social Security. Once you hit your full retirement age, which for most of us is going to be 67, if you're, again, depending on when you're born, there's a transition period there. But once you reach your full retirement age, what happens is you're able to get your Social Security, and you can work at the same time. And why is this coming? There's like a phantom person pressing buttons on my screen. Anyway, we'll get there. All right, Social Security. Because if the truth is, if you take at age 62 or less than your full retirement age, you have to take a reduced amount of Social Security. So it's going to cost you in the future, but you get to start earlier, which is sort of cool too, because you can, again, start building up, benefit or that cash as you go. But there's a strategy there. And certainly there's an article in the Wall Street Journal about a year ago that basically said pretty much everyone would be better off if they didn't take their Social Security until age 70. And the reason is that just like there is a reduction of benefit between age 62 and your full retirement age, in between your full retirement age and age 70, there's an accrual of benefit that happens in your Social Security. That's about 8% per year. And it gets divided ratably on a monthly basis. So every month you wait past your full retirement age, you just get a little bit more benefit. And at the rate of growth at about 8%, that's actually pretty darn good. And so typically you're better off waiting to age 70. Now, once you hit age 70, there's actually no reason to wait any longer because your benefit will not continue to go up automatically at that point. But again, people will tend to say, again, if you think you're going to die younger, you'll tend to want to take Social Security earlier. Typically, that's not going to work out the best for you. People also take on too much portfolio risk, and there's a number of reasons behind that. If you have, your IRA or you have a brokerage account, nest egg type of account, especially if you are sort of behind the eight ball a little bit, or if you really don't have the assets to support what you need, you try to take risk to make up for it. And I've seen that situation, and I've seen it go really poorly, where we had a client in our firm who started taking their distributions in 2006 at a very high clip, and they needed those distributions. And then 2008 hit, their portfolio went down by 50% because they were essentially all in the market. But they still needed to take money out. So because they still needed to take that money out during a huge down market, historical, they had to sell their stocks during that time, which is the worst time to sell stocks. So if you're really keeping a high rate of distribution, you take on too much risk, your portfolio is gonna, when the market goes down, not if the market goes down, but when it goes down, your portfolio is gonna suffer. And then people tend not to think about the tax necessarily, or they don't think about what's the best order to take distributions. And so sometimes they'll rely on their IRAs too heavily when they should actually be using, again, a brokerage or a taxable account. By doing so, they may end up paying more tax or push themselves into higher tax brackets than they really should be. So how do we measure the risk that we have a longevity problem, or that we're going to be possibly running out of money? And the way we do it at my firm primarily is through model-based analysis. So we use modeling to try to figure out what is our probability that someone will run out of money. And the technical name for this is called stochastic modeling, but the industry way we say it is called Monte Carlo simulation. And essentially what ends up happening is you take all the person's assets, whether it's their house, maybe they have rental properties, their IRAs, everything, and you say, okay, based upon how we are investing this money, and the rents that are coming off, maybe the rental properties, and how much we think we're going to be spending, do we have enough? If we match up, what our expected rate of return is to our assets and the depletion we're going to be running on those assets, does it last? And I literally didn't touch anything. Does it last? Um, and um, and then you find out yes or no, and then you can try to put in what if scenarios and say, well, what if we end up in long-term care? What if something happens, and we need a larger sum of money? Run all those scenarios and you say, okay, our probability of success, meaning not running out of money, is 90%. If it's at 90%, you can be very confident that you're not going to run into any problems. The other way that I've seen advisors do it is sort of more of the back of the envelope method. And so there's a really famous experiment that, or I guess experiment that was done in the early 90s by this guy named William Benzig. And Benzig took a portfolio and he said, I want to assume that I have 50% of my portfolio in the S&P 500 and I have 50% in the T-bill or bonds of some sort. And I want to see how much I can withdraw from this portfolio on a consistent basis and still have my portfolio survive the Great Depression. That's what he did. So what he found is that if you have 50% in the market, 50% in bonds, you could survive the conditions of the Great Depression if you withdraw 4% of your portfolio or less. So what some advisors will do is they'll say, great, what are your total assets that are going to be invested? It's X, you can include your rents on that as well from real estate, but what are the assets invested? Okay, 4% of that is X dollars. Okay, how much are you spending? Okay, you're spending Y dollars minus your rents that you're getting. Is that 4% number enough to cover your distributions? Yes or no? And that's how you measure the longevity problem. But again, it's simplistic, but it's a great check, sort of making sure you're thinking about things right. So we'll often use that when we're doing our modeling, is saying, okay, does this model make sense? If we use 4%, do we get somewhere close? But again, that's how you can take a look at whether or not you think you have enough. So how do we start to understand taking our longevity risk and off the table a little bit? So again, that Wall Street Journal article says delay to age 70 if possible. And I think that's one of the best ways to do it. When you take your Social Security early at 62, and you compare it to taking it at age 70, the crossover point at which you get more by waiting at age 70 as opposed to 62 is somewhere in your early 80s. So there are scenarios which if you had some sort of disease where you feel fairly certain you're not making it past your early 80s, then sure, take it early. But even if your parents lived maybe into their late 70s, the truth of the matter is that medical technology is better today than it was however many years ago, even 5 years ago. So I mean, likely you're living past your early 80s. So delaying is usually the best strategy. That said, some people aren't able to delay because they just simply don't have the assets to support. That said, I had a client who had his portfolio and we were withdrawing at a rate that was probably higher than what I would normally be comfortable with. But he had a strategy, and his strategy was, look, I'm going to take a little bit more out of my portfolio for the next, I think it was 7 years, and I'm going to delay Social Security. Now, once he hit age 70, at that point, we said, okay, your Social Security is $4,000 a month. We are going to reduce your distributions by $4,000, and we got his distributions down to a much more reasonable rate. So there are some strategies and there are some ways to work around that 70 number. And then the hardest part is adjusting to reality. In that, when I first started in the industry, but the general rule of thumb was people, when they retire, spend about 80% of what they spend currently. after doing this for long enough, the answer is almost 100% of what they're spending, if not even a little bit more. And so sometimes, sometimes you can keep that up, and sometimes you can't. And sometimes you just have to have a hard conversation with yourself or with a loved one or client. Um, Consider what your goals are. What are you trying to accomplish? What do you have in excess of what you have saved up, and keep your diversification proper. And I say that, it's like it's like a duh moment, but the truth is that I see a lot of people who don't keep their portfolios as diversified, primarily because they tend to want to go for income. And they say, okay, I want a high yields or high yield stocks. So they go out and they get a bunch of high yield stocks. All right. Well, the problem with high yield stocks is that they end up being clustered in certain sectors. So if you're going for high yield, what you'll often see is a lot of oil and gas stocks, a lot of telecom stocks, a lot of real estate type stocks, because they tend to give out more dividends. But the problem becomes, if something happens, you are not, and they cut their dividend, or again, whatever occurs, you end up with a diversified portfolio, with a portfolio that isn't properly diversified. So if you're going to leave out essentially tech, because tech typically doesn't pay that great a dividend, well, some do, but certainly small tech does not. You're just not going to have the right portfolio for you. There's me a Q&A, by the way. I should have mentioned that. I'm going to hold it to the second presentation that I have. So if you have questions, you can hold them or you can put them in chat. All right. So now we're going to transition on to being house rich or cash poor. And just to get a definition out there is, for me, a house rich cash poor person is that when you have too much equity in an asset that's not kicking out income for you. And we think a lot about when we think about cash poor, at least I'm guilty of thinking, oh, it's for young people, right? Because young people, they don't have, usually their incomes aren't as great, but maybe they put everything they had into a house, so they don't have a lot of liquidity on the side, and their mortgage is really high, and so I think of young people when I think of cash poor, house rich, but certainly for people who are in that retirement phase, house rich and being cash poor is a thing. And the way we identify that is saying, does this person not have enough liquidity on their net worth statement? Does and what also is endemic to having a house rich situation is you typically will be sitting on a powder keg of tax. So I'm going to tell this story. I'll hit on it at different points throughout this entire rest of this presentation. But I had a client, she was 95 years old, and she bought her house for, I want to say $50,000, in the 1960s, something like that. And I had inherited her as a client from a different advisor. And with me, in terms of what I was managing at the time, I was a younger advisor. I was managing, it's like $150,000. It wasn't a large amount, at least for our practice. And then what ends up happening is at some point she was not able to take care of herself. And so as a result, she needed to go to a facility, and she didn't have the assets with me to get her into a facility. So she sold her house, and much to my surprise, her house was worth $2 million. So she sells her house and she has essentially $1.9 million capital gain. And trying to figure, and we'll talk more about how we tried to get around it a little bit, but again, that time bomb is sitting there until, and if there's a husband, wife and wife, and spouses, a married couple, obviously the first person that dies, the tax is going to go away in a community property state. So, you don't have to worry so much on the second to die, or after the first person passes away. But certainly if it's a single person, or if it's a couple, again, that tax is going to be sitting there for you. A house rich person tends to also have a lot of confidence, because they think, well, yeah, sure, I don't have a lot of cash, but I do have a $2 million asset sitting here. And I say it's a false sense of security because the real estate is not readily turned into cash. And that could potentially, give you some problems. So, again, we don't have enough emergency fund, when we have a cash poor situation. So something comes up, like my client, she had to sell her house, and thankfully it wasn't during a bad time. So she was able to get the money out, but nevertheless, it took time, and it could have really gone the other way. When you have that house rich situation, again, if your house starts declining, like my client, you're going to have to sell it, and you're not going to have options, which stinks. I also want to make sure that Prop 13 is still front and center, just because some people say, well, I do not want to give up this house, because I don't want to give up my property tax basis. And I don't blame them, but if you're living in the house and the person who's inheriting that house isn't going to live in it themselves, they're going to have a huge increase in their property tax basis. And even if they are living in the house, it's limited that they're going to get $1 million of relief above what you already have, as your tax basis. So I mean, you may, again, in the case of my client, if she would have left it to the kids, and the kids even would have been living in the house, their property tax would have gone up by like $12,000 a year. So food for thought when people are considering selling versus not selling, and the benefits of doing both. Certainly the income tax problem, goes way up death, but the Prop 13 problem does not necessarily, or it is not fully abated. So what are the things that we look at, for solutions, if someone is house rich, cash poor? We look at potentially mortgage, reverse mortgage. I've looked at it a few clients. We're going to talk about each of these as well. People look at home equity line of credit, and then and some people that downsizing and moving is the correct option. So, talking about the good part of the home equity conversion mortgage, or the reverse mortgage, the reverse mortgages have become way more flexible, over the last probably 10, 20 years. And right now you can get a lump sum of cash up front. You can get, my computer's possessed. You get a lump sum of cash up front. You can get monthly payments, or you can sort of have an on-demand system where you can write checks almost out of your house. So you can have a lot of flexibility. It turns out you don't have to pay anything back if you don't want to, which is helpful for that cash flow situation. So you can alleviate if you get a big lump sum up front, then you can turn around and say, okay, well, I'm just going to use this cash to live on. The borrowing limits for the home equity conversion mortgage the lending limits are based upon age. So starting at age 62 is when you can do your reverse mortgage. And then as the person ages, the percentage they can take out of that reverse mortgage goes up over time. And the other great thing about home equity conversions is that they are non-recourse, meaning that if you end up at the end of this thing and your house falls in value, or you live long enough that the mortgage, the balance goes up above the value of your house, I'm giving up on this thing. It goes above the value of your house. You you don't have to pay anything additional back. The house is the thing that's going to back the mortgage up, and only that thing. And it has gotten more tightly regulated, which is nice. So, it's not like the old Wild West. But there are problems with reverse mortgages. Typically, your interest rates are going to be a little bit higher, which can be a tough pill to swallow. And what that means is that, and there are also much there are fees. Not saying the fees aren't as bad as they used to be, but they're still substantial. And those fees are going to be capitalized into the mortgage, meaning that um, whatever those fees are, that's going to add to the balance. And then same thing, the interest, even though you're not paying monthly payments, that interest ends up being capitalized into the principal of the mortgage. And so as that happens, as the balance grows, the interest load also grows, which of course also increases the balance of the mortgage over time. So again, if you're in it for any length of time, it becomes at some point prohibitive, or it becomes very expensive to try to pay it off ahead of time. And if you live long enough, it's certainly a decent likelihood that there may not be a whole lot left for your heirs. But if you need the money to live on, you need the money to live on. The other problem is that if you're living on the property, great. If you end up moving permanently to another location, you need to pay the home equity line of credit back as soon as you're no longer residing there. And that means inheritance for future generations, it's going to be impacted. Again, you can sell it. And then obviously, if you need it and you sell your property and you end up in a facility of some sort, you're not going to have as much left over to get into that facility where you need. So certainly it can be really helpful, but not for everyone. So home equity line of credit, a little different than your reverse mortgage. Essentially, it's like you have a checkbook for your house. And so what that means is, sorry, let me move this off my screen. So what that means is that instead of having a bank account and writing a check, you can just sit there and write a check using your home equity. And during the draw period, which is typically about 10 years, when you go to pay, you have to pay the money back. You only have to pay interest only for the first 10 years. The fees on a HELOC tend to be not as great as a reverse mortgage. Typically, your appraisal fees and title, and there are fees, not saying there aren't, but it certainly tends to be cheaper than your home equity conversion. And there we go. Interest is variable, so if the interest rates go down, you pay less interest. Now that leads us to our not so good. The interest is variable. And as somebody who got his home equity line of credit in 2020 and was really happy about it because his interest payments were only 4.25%. And then in 2023, they were closer to 7.5%. It is not so fun. The variable mortgage thing when it goes not in your favor. You do have to qualify for this loan. You do have to have debt to income, or the right debt to income. You do have to have, your loan to value has to be right. So it's not like it's a slam dunk. Oh, just go get a home equity line of credit. If your only source of income is your Social Security, you may not be eligible to use that home equity line of credit. And of course, there is a repayment period. As we said, the 10 years, the draw period is great, but you do have to pay the money back in year 15. And after year 10, you have 15 years to repay the loan entirely, unless you do refinancing. But as before, you have to qualify for the refinancing when it happens. And the limits may be lower on a HELOC. So again, the debt to income thing can really impede how much you can take out of a HELOC. In addition, usually I see HELOCs at around 250. I've seen them as high as 500. So you're not gonna be able to pull all of that equity out of your home, for sure. So our last method that I see is the downsizing slash renting piece. Um, the good part is the complexity isn't as bad as trying to do the whole, getting a loan application out, and certainly the home equity conversion mortgages does have complexity to it. In this, you're selling and either buying or renting, so it's a little more black and white. Um, the also good thing is that when you do it, you can potentially get out of the home with no debt. And so you turn around, you buy your next house, either for cash or maybe a lower mortgage. Or when you go rent, again, you have your pool of money, but no debt. And it's how you get the most equity out of all the choices, right? You sell it. Now there's going to be, we're going to talk about the transaction fees in a minute, but it's really how you get, again, the most out. So downside is we talked about the powder keg of tax. I'm going to talk briefly about how you start to deal with some of that tax, but I don't want to make it too awful for you. Um, and then the transaction cost, right? You're going to pay a realtor. You're going to have to fix up the house a little bit. There's going to be all the other fees that happen. So it's not free. And then my big warning to people is when you're going to do it, and if you're going to move out of your area, because I mean, if you're going to sell your home in the Bay Area and you want to move someplace cheaper, you're probably not going to want to stay in the Bay Area because it's so freaking expensive. Um, and when you move, let's say I've had clients move all over the place because they're like, this place is the Bay Area is too expensive. I've had several clients move. I've had a couple go to Texas. I've had one go to Washington, and then I had someone go down to the Palm Desert. It's a little cheaper down there. And I will say this: I've seen it work well, and I've seen it turn into a disaster. Um, where people think, oh, well, I'm going to save all this money. And it's true, they do save a bunch of money, but they also leave all of their friends and family and they get to this new place and they're very lonely. And a lot of times they move back or they move to a different location. They're constantly looking for, the next best place because they just can't, they're just not comfortable. So that's the bigger problem, I think, with the downsizing piece is that it's the social disconnect that happens. And then once you have that cash, you need to decide what you're going to do with it. Are you going to try to put it all into the house? Are you going to try to create sort of pool of cash for yourself for emergency purposes? And how are you going to try to live off this money from here on out? So, since I have a little bit of time, I'm going to talk a little bit about tax strategy, and we'll get to Q&A in a second. But the tax strategy that we use a lot when we have someone reinvesting, and this is um, this is the person who I talked to you about, who the 95-year-old who sold all of her who's had the $1.9 million capital gain. So what happened to her is that she got this money in. We needed to make sure that there was enough assets there where if she lived another 5 years, she could pay for her care. But we also needed to work on capital losses. And so when you have a mutual fund or when you have an ETF, those are really great tools to work with. And I have mutual funds and ETFs in my portfolio and my kids. But the problem that mutual funds have is that even in a really good year, and this is the first half of 2023 on your screen, even in a really good year, um, you can have in this case, almost half of the S&P 500 was actually at a loss for the year, even though the S&P itself was at about 17%. And mutual funds and ETFs do not pass out losses. So those losses get stuck inside of that ETF or mutual fund. So one of the things that you can do is you can have a portfolio and you can say, okay, well, I'm either going to invest it, or or in my client's case, we had a bunch of T-bills. And we're going to take those T-bills and we're going to build leverage on top of it. So we're going to borrow money based off of in my client's case, the T-bills. We're then going to turn around and we're going to buy the market. And in this case, I say the Russell 1000, which is the biggest US companies. And that's a really risky portfolio if you do that. And you wouldn't want to put a 90-year-old woman in a leverage portfolio with the Russell 1000. So what you do is on the opposite side of that, you short the Russell 1000. So you've both gone long and short. So meaning you've bought the market and sold the market at the same time. You have to use two different sets of securities to do this, but essentially then what happens is the market goes down and you have a bunch of capital losses and you collect all of those capital losses. And then the market's going to go up and you're going to have capital losses on the market that you shorted. And so you're going to collect all those capital losses. But the whole time, because you have both sides of the market, you're really in no worse economic position. So in my client's case, we started this in June. Client died, unfortunately, 3 months after this whole thing started. And we were able to get about $60,000 of capital loss over that period of time. So we saved the family between California and state about $18,000 just by doing this. So if you have a client situation where they're going to have a big capital gain and they're going to have securities left, or they're going to have money left over to invest, this is probably a good way to think about doing it, because you can really start to grab losses at an aggressive rate. So in this instance, what this is showing is if you have a very large sum of money, this is if you had like $5 million to invest, right? You could potentially get 64% of the value of what you put in. So about $3 million of capital loss. If you had a whole year to work with. So again, it can be a very powerful tool for those that have big capital gains because they had to sell property at a time when, again, they just had to do it. So again, the tax thing is a big deal. So that's my presentation. I got about 40 minutes in, so I went fast, so I apologize. But we'll certainly take questions if you have them. I was looking at the chat here. Yeah, keeping up with the HELOC payment is a thing, right? It's not like, so yeah, if someone who had written, saying, hey, look, yeah, you have to pay the interest back. So when I first started, my interest payment, was like 1,000, what was it? 4% of, because what I did was, and you real estate people, you'll appreciate this. Because the bank was giving me such a low rates, I turned around and I said, well, I'm just gonna go buy property with it. So I turned around and I bought 2 houses in the Dallas area. And so I had about my balance was like 500,000. So my let's see, my payment of 500,000, that's 20,000 a year. So what's that, like 1,500 a month? And then by the time, now, and then all of a sudden it became closer to $2,500 a month debt service. So yeah, keeping up with the HELOC payments is real for sure. Yeah. So anyway, if there are any questions, happy to answer them. Or you can type in the chat, you can shout it out. I don't know how many people we have here now, but
Was there any new information, you guys, that you picked up? Things that you didn't know before? Like all of it? I mean, we know a little something about, some things, and a lot of this just added to our cache of knowledge about things.
So
I would like to know like okay, go ahead, John. Go ahead, John.
Okay, so Aaron, this is a great presentation. Thank you. I had a couple of questions on the issue of delaying Social Security until 70. Right, that's conventional wisdom. You see it everywhere. And you mentioned an exception where somebody just plain may need the income earlier. What is the escalation factor in delaying for Social Security payments? I think when you said 8%, is that what you were referring to? So if you take Social Security at age 62 versus age 70, the payment at age 70 would be 8% compounded annually for 8 years, that much higher?
Yes.
Okay. All right. So the basic math to do there is if that you're going to be making additional withdrawals, most likely, if you're waiting until you're 70 for Social Security. So I guess the math you got to take there is that what you're withdrawing, that you wouldn't withdraw if you took Social Security earlier, would have to earn more than 8% a year to break even with the idea of delaying Social Security payments.
Right. So
Right.
and I mean, if you're the average S&P return for like the history of the S&P is around 8%.
Yeah.
And so, if you're sort of almost getting that guaranteed 8%, again, unless you really need that cash, it's a pretty good bet. A guaranteed 8%. You can't get that anywhere else.
Okay. All right. Great. Okay. Then the other thing that was interesting to me, because I happen to have a business that focuses on this, is when you mentioned some people have to adjust their living standards to reality. Reality meaning you're looking at life expectancy, you're looking at the total value of the portfolio, and you're probably using the 4% rule as a guideline. And if 4% withdrawals are not sufficient to cover their budget, you have to adjust them to reality. Okay. How do you work with clients at a very granular level to help them make those adjustments? Or is it more, okay, here's the gap, please try to make those adjustments. And you may have some big picture ideas, right? You may have some financing options that maybe they pushes out some of their liabilities, improves their shorter term cash flow. I'm not sure, but my business actually involves working with clients at that more granular level, like
Sure.
every
So
line item of the budget.
yeah, so we usually go through every line item of the budget, but what I start every client out with here, let me give you a tool so you can, because the truth of the matter is people have no idea what they spend. Like they do, and they don't know what they spend it on.
Right.
And so,
Yeah.
just the exercise of saying, hey, go through your credit card and your bank statements for the last 6 months and total what you've spent on everything. I've had people, that have just been appalled at how much they spend on DoorDash, because they just did not realize exactly how much they were spending. So, I mean, I I tend to let people, figure that out for themselves, because usually people will look at it and say, "Oh, wow, I spent a lot on X, Y, or Z." When doing the planning piece, a lot of times people say, "Well, we want to take an international trip every single year for the next 10 years." Okay, well, how much is that going to cost? Well, probably close to $20,000 a year. It's okay. Well, if you do that, well, what if you made it every other year? Does that make sense? Or but to answer your question, I
All right.
usually don't go too deep in any one line item, but if there's something that stands out, I'll make a recommendation on it. But again, I'm not combing through it.
Yeah. Okay. Thank you.
Okay, Carlos, you have a question. Hola, Carlos. Hello.
Sorry, I had to find my way out. some documents here. So you mentioned $2 million home for this lady, and she had to pay 1.9 million.
No, no, no. Her gain was 1.9 million.
The what?
Her gain was 1.9.
Oh, gain. Okay.
So I apologize if I misspoke. I apologize. So it was about because because it was over $1 million, she was in the she was at a 13.3% bracket for California, and then she was like 23.8 for federal.
Oh, okay. Is there a way to avoid if she had put the house for rent instead of selling it, she would be better off 2 years later, right?
If the income was enough to do that, because she was spending $12,000 a month on her care. So that I don't think the rent wouldn't have been enough.
No. So you educate people to prevent these kind of problems.
So sometimes there's things you can do. Like I showed the strategy before of trying to eliminate capital gains through loss harvesting. Sometimes, and I just had a meeting right before I walked in here, sometimes you bite the bullet because sometimes it's what you got to do. And I hate it, and I hate paying tax, and I hate when my clients pay tax, but sometimes you don't have a choice. But you do the best you can.
Yeah. I was talking to somebody the other day. He said, I don't care about taxes. I just pay them. Everybody wants to save taxes. I just pay what I have to pay for taxes because I'm grateful to have a house.
Okay, well, they are a better American than I am. I do not like paying taxes. It's one of the things I try to do the least of.
Yeah, some people don't like the problem of doing all this stuff to avoid taxes, so they just want to pay.
Well, a lot of it depends on the effort, right? Because you can get into some really complex stuff, like we've had clients do things like QPERTs before. So if you're not familiar with the QPERT, it's a qualified personal residence trust, but you generally need 10 years to complete the transfer, and it's costly because you have to get someone to do the trust for you. But again, if you have the foresight for it, it could be really helpful. But sometimes you get stuck paying tax.
Can I ask another question?
Yeah.
So you mentioned downsizing is more costly than anything else. Is that correct?
No. Well, there's a large upfront cost to it. Because you're gonna lose whatever you're paying to your real estate agent, plus all the other things that you have to do. So, but over the long term, it probably isn't, because if you live long enough in that reverse mortgage scenario, you could lose you will lose all of your value to interest, and capitalization of interest. So that can be quite costly overall. So, but there's a large upfront cost for sure on sale.
Is there any scenarios where there is the difference between paying the interest, which is kind of compound interest on the reverse mortgage, versus the equity that you get on the house over the next 10 years in Silicon Valley?
I'm sorry, I didn't quite catch
that. Is there a scenario where you can say, hey, yes, you're paying a lot of interest on the reverse mortgage, right? But on the other hand, if you stay in the house, you gain equity, and that equity would pay off.
Right. Well, right. And you hope, right, you're gaining equity.
You cannot.
I mean, because what the interest rate, and I think the interest rate right now, I thought I read on reverse mortgage is like 7.5 right now. So if you're going to turn around and you're going to pay your interest off every month on the reverse mortgage, which you can do, will you have enough cash left over to make it worth your while to do that? I don't know. It's a risk. But so your assumption, so let's say you got, $1 million out of your house. And you're gonna owe $78,000 a year in interest. And you take that money that you're going to deplete it by $7,800 a month because you're going to pay off the balance of the interest every month. That you really have to hope that there's a good appreciation amount on that house, so that you can either have a different reverse mortgage to pay off the first. But to me, that sounds risky, but I have not done the math on it.
Well, that's new. Thank you so much for that answer.
So that just makes me think that, so for your client, the 95-year-old, that's one set of issues, because at that advanced age, it's a different math to look at. And then, especially for a reverse, 65 to 75 is one set, 75 to 85 is another set. Do you do projections for different scenarios? And then there's other products too for tax deferment, like DSTs and specific trusts, family office kind of stuff.
So I mean, for DSTs, are you talking about deferred sales trust or Delaware statutory trust?
Either one.
Okay. So the deferred sales trust, no one has been able to convince me yet that deferred sales trust is not a step transaction and is a valid way of doing things. I've talked to a couple DST people. They've shown me numbers. They've showed me code sections, and I've not been moved. The Delaware statutory piece of it, right? If you and I'm working with a client potentially on this right now, is that they have their Silicon Valley home that they lived in for 30 years, and the gain is 1.4 million. And we're talking right now about, can they move out of their house and go rent in a cheaper location, make that property an investment or rental property, and then turn around and 1031 that into a different property, and then wait another year and a half or 2 years to try to get that property to not undo your exchange, and then move into that second property, later on. It's a lot of hoops. And a lot of clients don't like it for a couple reasons. One, it's a 4-year process. So it takes a long time. And then two, you're going to have some rando living in your house that you want to live in, and people don't feel good about that. But I always bring it up.
Well, strategies are just endless. I mean, people, come up with strategies all the time, and they come at us all the time. Go ahead, Lynn.
Hi, Erin. I'm Lynn, and thank you so much. I feel like we all need more financial literacy education ourselves, as well as, let alone educating people that we serve. And so exactly what you talked about, I did. We have this huge listing here. It was like 8,000 square foot home, and we were inviting people, the neighbors, to a wine and cheese. And one of a senior walked to the door, and he took the invitation, but then he said, we are actually thinking about going closer to our daughters in West Covina and, and Poway. They wanted to help take care of the grandchildren. But because of capital gains, we're kind of stuck here. And I said, okay, so I can introduce you to some people. And so just like, I introduced him to somebody with DST, I introduced him something with Trust, and then also to a 1031 exchange specialist. And believe it or not, he chose that way because we also have a property management firm. So we were able to help him coordinate, because they were also not so sure where to buy exactly, which areas they liked. So they're renting. So it worked out for them. So where would you fit into this piece to add, to this portfolio of, strategic partners that we have. And do you operate on like a per fee basis for consultation, or based on the securities you introduce, you get a commission? So,
Yep.
yeah.
Yeah, no, that's a great question. So it sounds like you're asking like more of my personal business, which is fine. Happy to talk about that. Yeah, so we're an assets under management firm. So we do is we help people who have assets and then try to figure out what the best strategies are for not just this, but also the investment side as well. I refer people out to hourly planners all the time because we're not a good fit for everybody, and that's okay. So if you come across someone who says, look, I don't really want someone to help me manage this, I don't care about tax, then we're not right for you, and that's okay. But all they need is hourly work. Again, if you need an hourly referral, I'm happy to send that along.
Oh, okay. So you're a property manager, or what exactly?
Oh no, so
Or no, sorry, I couldn't understand like where you.
no. I appreciate it. No,
Okay.
no. I sometimes I get too hip for the room, and don't even think about it. So yeah, so I am we're a wealth and tax firm. So we help people invest their assets, do financial planning around the assets, and then try to do things on a tax efficient basis. So we're a financial planning firm that charges people based upon the assets that we're currently managing. Does that-
Actually, he's the personal manager for me. How long have I been with you? It's been what, maybe 20 some years?
it's been 15 years. Well, almost 15
15.
years because
Yeah, and he's made me a boatload of money, kept me out of the poorhouse. So he's
Oh.
he's doing something right. Yeah.
I am not accepting any endorsements because the SEC.
But what type of so you're helping manage the accounts, or what are you helping manage?
Correct.
Sorry.
So when someone likes, I'm not going to talk about Skip's situation because it's his personal stuff.
Oh,
But
okay.
Yeah.
but when people have what people come to us and they say, okay, we have an IRA, we have a Roth IRA, we have a brokerage account, we have and these are the problems we're trying to solve for. We'll help manage all of those. And by the way, we also have these 2 rental properties, and we're not quite sure what the best strategy is. So even though we don't technically charge on those properties, we will give advice around the properties themselves. So again, it's the financial planning piece, because to me, you can't do financial planning in a vacuum. You have to know everything. And so what we do is we will advise on the person's whole life strategy. Certain exceptions. I can't make people do things, but but again, our fee is based upon what we're managing.
Okay. Well, it sounds like, do you have to have a certain amount of net worth in order to have your services?
Yeah, so the minimum for me is $2 million of investable assets.
Okay.
And then we have other CFPs in the firm that their minimum is like $1 million. So again, I'd say anything above $1 million we can help people with.
Okay, but that doesn't include real estate, right? The 2
No,
million.
we don't charge on real estate because it's hard to know the value of it, and that's how we tend to charge on things. So
Okay, so when you say 2 million of investable assets, those are outside of real estate assets.
correct, securities, stocks.
Oh, okay, got
bonds,
it.
ETFs.
Okay. Very good. I'm like, maybe we should book appointment with you first so we can you
Sure.
can
Yeah, you're
be
welcome.
the guinea pigs and then know what you do exactly and then refer. Yeah.
Yeah,
Yep.
I was a good excuse to go to coffee at San Pedro Square. So
Okay. Where is your office located?
we're right by San Jose Airport.
Oh, okay. Yeah. All right. Wonderful. Thank you.
You
Yeah,
have to understand what a financial planner does, where he looks at all the assets and devises a way to help you get your goals, whatever they are, within the amount of time that you allot, with the amount of risk that you can take. And this is typically what a financial planner does. If you go back in our Tuesday meetings, Aaron, at the beginning of our presentations, 2 years ago, did one on what a financial planner is, and you might want to review that just to catch up on the details on a planner.
Mm-hmm.
Yeah. I mean, there's all sorts, right? So, so for us, like we're what's called a registered investment advisor. So we're fiduciaries to our clients, so our clients pay us. We don't get commissions. There are other planners out there who do commission-based work, where they get fees based upon what they sell. And then there are some that do hourly work where they don't work on the managing of the assets at all. You pay them a fee for every hour that they do their planning, and you go on. So lots of different ways to do it.
Mm-hmm.
But I wanted to, so Jim Biller, who I'm not sure he's still here,
You mean
mentioned,
Dan?
what's that?
Dan Biller?
Oh, I'm sorry. I said Dan. I'm sorry. I meant to say Dan. So Dan, I said Jim. Okay, Dan said that the reverse mortgage rates are lower than the 7.5. I went onto ChatGPT, so I apologize if I have the wrong rates. But I said it said it was between 7.6 and 7.9.
Well, they change every day.
I
And
guess.
Dan is our very own Heckham expert.
Cool.
That's what he does. So great resource there. When you work with families, so you do the wealth management part, and like John is a daily money manager. So and actual fiduciaries too. We have a few in our group as well. So do you work with all of these professionals for the families together?
Yeah, it sort of depends on the need. I work with lots of professionals. I tend to work a ton with estate planning people. But certainly, if someone comes in and they have a budgeting expert that they really like, I'm not going to tell. I mean, if it's working for them, I'm not going to tell them to stop. And because what we do is when people come in and budget, we largely have them do that function themselves. Like they go through their checkbook, they go through all their, like we don't do that amount of I'll say bespoke work that John probably does.
No, that's good to know. So I can see a compatibility though in there. So sometimes we have conversations with senior homeowners and families of senior homeowners where the senior homeowner is facing a crisis or a challenge, and we happen to be there however we got there. So we want to be able to have some answers, some solutions, some offerings. And so it's important for us to understand all of this, so that we can listen and that we can surmise and maybe make some suggestions for going for the families that we work with.
Yeah, and to me, I would think of me when someone needs a tax solution of sorts. Because in our firm we also do tax returns in-house. So people who are clients of ours, we also do their planning and preparation.
Okay, compare and contrast that with, like, I have an accountant, I have a CPA, I've had for years. And if I walk in and say, I need a tax strategy for X, a capital gains type tax strategy or some other large event, and they go, yeah, sure. I know, I gotcha. And then, the return and everything happens, and they have no idea, really. They just tell you they do. And how are we supposed to know?
Yeah, well, I mean, and I will say the tax people that I tend to work with, CPAs in general, tend to be more conservative, just as is. So, you're going to have they hopefully will give you some ideas, but a lot of them will probably just tell you to pay the tax, is my guess. But
Pretty much. And there's always a case to be made for just pay it, like you said earlier, bite the bullet, get her done, forget about it, move along, move on with your life, really.
Yeah, and a lot of people choose that route.
Yeah.
So Carlos, I saw your question here. Installment sale. Installment sales can be can be very helpful. But you know, again, as long as I've never done an insurance company facilitated installment sale, because right, the danger in that is obvious, right? The seller, I'm sorry, the buyer just doesn't perform. And then you have to try to collect, and that could be pretty messy.
Okay, can you explain that, please?
Yeah, so yeah, if you sell your home, and you know, most people go out and they try to find their financing, you know, through third parties, banks, other lenders. But you can absolutely have it where the buyer pays the seller who's going to carry the note on the house. And so, you know, you set an interest rate, you know, they have a down payment, and then as the money comes in from the house sale, from those installment notes, you end up, you recognize that on your tax return. So each amount that you get, each monthly amount, assuming it's a monthly amount, is going to be principal, and part of it's going to be, no, I'm sorry, is to be capital gain, principal, and interest. And so you have to recognize the appropriate amount based upon the interest rate, and then you report that on your tax return at the correct location. Now, if it's a 20-year note, that buyer is going to pay you for 20 years. You hope they pay you for 20 years, because if they stop paying you, now you have a problem. Now you have a default on a note that you have with somebody else, and that means you have to try to collect on it. And most people are not in the collections business. So that would mean you would have to go out and try to collect it via the court system. And that could get messy. Now, that said, you can sell that liability to somebody else. I'm guessing, you know, that was your insurance company example, where you sell it to a company who's going to collect on your behalf. They pay you, they're not going to pay you the full amount, right? Because they want to make money. But I've never done that before, and I've never seen it, and I don't know who offers it. So I'm not 100% sure how that would work.
Yeah, basically, when an installment sale, you assume the position of a lender and all the responsibilities. So you got to make sure that you screen them right, you get all the legal documents right, and then, like Aaron said, in case of a foreclosure, you're going to be the one that has to do the foreclosure on the property itself. So there's some pluses and minuses.
Yeah,
Yeah.
and the question is, can you shovel off that liability elsewhere and not have a constructive sale? That's good. It's a good question. You know, but if you're going to get like a lump sum up front from the insurance company, to me, that's no longer an installment sale. That's just that's a closed transaction. But if you're going to get the installment from the insurance company, but the insurance company takes on the risk of the default, okay, I can still see that being an installment sale, but I don't know how much it's going to cost to get the insurance to do that.
Yeah.
Thank you.
All right, anybody? Lynn, did you have another question, or are you good? Your hand's still up.
Oh, sorry. I just wanted to see when you say $2 million for your minimum, does that include 401k programs or no?
Yeah, it typically does. You know, there's an app for that. There's an app out there that will help connect us to 401k platforms so that we can trade on those platforms, and do the management that we do just on a 401k basis.
Okay. So basically, before you meet with anyone, they probably should fill out some kind of sheet.
Yeah, well, you know, I meet with anyone, you know, at least initially, and we talk through, you know, what the expectations are, and then, you know, at some point either someone asks me my minimum or I tell them, and they're like, okay, that's great, or they say, you know what, I'm not a good fit, and most people are not. In my experience, most people that I talk to are not jerks, and they're, so I don't worry too much about it.
Okay. Okay, sounds good. Thank you so much.
Sure.
All right, everybody, it's raffle day.
Oh, raffle day. I like raffles.
I'm gonna be pulling it out of the bag today because Valerie's not here. She got stuck at another meeting. So,
But we will.
alrighty. I'm pulling it out of the bag. Ta-da. Let's see who I got. Anthony! Yay! Must be present to win, and there you are. Yay! Awesome, Anthony.
You got a new Mercedes.
Yeah. Oh no. Oh wait, let me see if I can do this fast. Can you see that?
Not yet. It's
Now can
getting
you see
dark.
it?
There it is.
That's the prize for this week. Ninja. Ninja. In honor of Seb, because he's our newest ninja.
Yeah, Seb just got back from ninja training.
Yeah.
You can-
So, and anybody not familiar with ninja, you are now, and it's a really
Yeah.
big deal. Good
It's
stuff.
a Ninja Turtle.
Ninja selling. What'd you say?
Yeah.
What did you say? What I missed it, Carlos. What'd you say?
Ninja Turtle.
Yeah. Yeah. All right, everybody. Great stuff. I hope everybody learned something new today. We'll probably have a lot of things pop up in our minds over time about our discussions for today. We are recording, so
Yeah, as
So-
I said, if you want to go to coffee at San Pedro Square, hit me up.
yeah, wouldn't that be fun?
Or virtually.
Or virtually. Yeah. We can do it the new school way too.
I don't know you know this, but you can have coffee with piquete. You know, piquete means in Spanish,
What?
a little brandy in the coffee.
Oh,
Irish coffee too.
Irish cream. Yeah, there you go.
Hi, Anne. I see you now. Everybody say hi to Anne. Hi, Anne.
I am. And I'm going to call you a little bit later today. So,
Skip, do you want to say? Do you want to have anything to say?
just next week is the digital inclusion with SourceWise. It's a great program for older people that are kind of computer shy, and we're going to learn all about that. So stay tuned for that. And Julie, how close are we getting to the website?
So the website is pretty much getting there. I'll have
Well,
something to announce after I get back from going to a conference next week. I'm going to the Senior Home Coach Conference next week. And I'll have a full report on all of our nationally connected SRES and Senior Home Coach colleagues. We're going to spend 4 days together masterminding. So I'll have like enormous amounts of information to share when I get back from this conference. It's going to be crazy. It's crazy.
but
You
when
can
we-
review. Oh, so go ahead, Skip.
when we get the website, we'll have all the recorded sessions on there, which is, we're pushing 50 of them right now. So you guys need to be able to access them, and we can only do that with a website.
Well, actually, we have them in the emails and the
No,
bulletin.
no.
The emails contain the link to the recordings,
All right,
and the
so
bulletin has the hyperlink
if somebody wants to do Aaron's thing on the CFP, how do they get to that?
on the bulletin that we had Aaron on. But now we are consolidating everything onto the website. So it will be super convenient. It's super cool and always an evolving thing. So, so yeah, I'm excited about that too. So is Skip. Can you tell?
Where's your conference located, Julie? What
Guess
city?
what? Okay. In Wichita. Woo!
Oh, right. Wichita, Kansas. Okay.
Oh,
I go to Dorothy Land.
Yeah, this is Catherine Ambrose's conference.
Mm-hmm.
Yeah, senior home coach. On page 4 of the bulletin is all the information about our senior home coach organization and the conference. And so you can check it out there. And Wichita, so I asked, I was like, I need a tornado report. And I'll take earthquakes over tornadoes any day. Seriously. All right, everybody. Thank you so much for being here. This was great. Lots of new information. I always love getting new information and really amazing nuggets. The best nuggets always come in at overtime. So just keep that in mind. Anytime we are doing Zooms, like our own Zoom or any Zoom you're on, and then you're like, ah, and then you're overtime, and then here comes a golden nugget. That's why we're still here.
Yeah.
All right, everybody, you have a great week. I'm gonna try to get in. I'm gonna Zoom in next week from the conference. I don't know what the schedule is gonna be for me on Tuesday, so I'm gonna coordinate with Skip.
You are?
So here's what I was thinking,
Really?
because if we're doing something really fun at 11:30 Pacific time, when I'm out there 2 hours ahead at 1:30, and if we're doing something really fun, I'm going to put it up on the phone, and then we'll just all be Zooming together. So that would be fun. Okay, I know it's crazy. All right,
Well,
everybody, you
Julie,
guys
I mean,
have a good week.
if you're gonna be busy, I'm happy to host in my Zoom room if anybody ever needs.
Oh, Lynn, that would be awesome.
If that's gonna help you,
All right, I'm gonna figure that out.
just let me know. I will
Okay.
be available on the 7th, the day before I go to the UPW with Tony Robbins.
See, okay, so here, real quickly, it was either I'm going to Wichita, or I'm going to UPW. And I told Catherine, I said, I'll go to Wichita this time because and choose. And it was a choice. We had to talk about it. So I'm glad that you're going because now we're represented.
There
That's
you
amazing.
go. I will bring back information because this might be one of his last times doing it. He's getting old, like we all are.
Okay, I'm older than Tony.
I have a quick
So
question.
you just had a
I
birthday.
know. I'm older than Tony, and I've been with him since day one. Let me tell you. Okay.
I have
All
a
right,
quick question.
everybody. Thank you so
Question.
much.
Oh, Carlos had something.
Oh, Carlos, go ahead.
Aaron, thank you so much for doing the presentation. Quick question. If I have somebody in front of me, what kind of question should I ask so I can bring you business?
Yeah, I think the question is, hey, do you have a capital gain problem, right? I guess the question is, how have you planned for the capital gains from selling your house?
Okay.
Oh,
That's
how
great.
do you plan for the capital gains when you sell your house?
Yeah, or have you, or
Oh,
how are you going
have
to?
you planned?
Yeah. Or how have you planned?
Oh, how have you planned? That's a good question, Carlos. For a
See,
good
nugget.
Ha-
All right, see, and the other thing, so Carlos is having a capital gains deferment webinar coming up for his group, his clientele. We all can participate on that. We're gonna send out, if anybody's interested in that, let us know and we can hook you up. Also,
On the
so
8th,
Carlos, quickly tell them what that webinar is.
the deferred capital gains with or without 1031 exchange. So that's just to call your attention that is possible, right, Aaron?
Sure.
On the other hand, on the 8th, Susan Daniels from LA, a lawyer, she would do a webinar on peace of mind planning. She was saying like peace of mind by the time you die, but I don't think it's a good idea to talk about that.
Peace of mind planning. So Aaron, you can tell we're trying to create all kinds of solutions and options and offerings so whenever we have any kind of a conversation with senior homeowners and the families of senior homeowners, we have we have resources for them. So
Right. And Aaron, you are an expert, or what is your background? I'm sorry.
Yeah, so I'm a CPA, and I'm also a California attorney, and I am a CFP,
What is that?
What is
a
that?
certified financial planner.
Okay.
Oh, so you're a certified financial planner, but you also have a CPA license, and
Yes.
what was the other thing?
An attorney.
I'm a California attorney.
Oh, wow. Gosh, you have a lot of continuing education you have to do.
Yes, I do.
Oh my goodness.
don't like a lot of us. Yeah.
Well, yeah, but I know for CPA it's 80 hours every 2 years. Is that correct?
It is. It is.
I don't know for California attorney, but I imagine there's something.
There is. I think it's 30 some odd hours for California attorneys, but I try to get as much packed into one class as I can. So when I'm looking for classes to take, it's do you offer CFP, MCLE, and CE credit all at the same time? And so if I can hit the trifecta, I always try to do it.
Wow. Well, maybe this is a coffee conversation because I'm now so curious how you came from a CPA to a California attorney to a financial planner.
Yeah, it was an interesting journey. So yeah, I'll
Yeah. Well, I'm also curious because my husband's a CPA. My daughter is going to be attorney. She's in law school now. So maybe should be financial planners later.
well, I like it. So
Yeah. Well, thank you so much, Julie
All righty.
and Aaron.
And thank you for
Thank you.
doing
Yeah.
that,
Thank
Aaron.
you.
Yeah. Have a good day.
Thank
Bye-bye.
you. Thank you so
Bye.
much. Thank you, everybody.
Bye-bye.
Thank you. Bye-bye.